Over the years, I've unfortunately known many people that have pursued dividend investing only to eventually walk away from the strategy. Statistically speaking, the majority of my subscribers are unlikely to achieve the goal of replacing their income with dividend stocks. It's not that dividend investing is hard or that it takes millions of dollars to retire off dividends. I've dedicated my entire channel to debunking the common belief that you need over $1 million to live off dividends. There's several reasons why people stop dividend investing, and they all resolve around a very common theme. In this video, I'll address the main reasons why so many people eventually give up on pursuing dividend or income investing to ensure that you can make it all the way to the end. Because obviously, once someone's achieved the goal of replacing their income with dividends, they don't abandon it because it's the best form of passive income out there. Unlike a rental property, where even if you have a property manager taking care of things, you still have to deal with them when problems arise, like damages and potential lawsuits from tenants. When you buy a dividend holding though, that's pretty much it. It doesn't require more than a few minutes a month if you're monitoring your positions. The first common reason people walk away from dividend investing is because they get burned trying to reach for the highest possible yields. Stocks and funds that are offering exceptionally higher yields compared to what's typical for their sector are almost always much riskier. And if you invest a lot of money in these kinds of investments, you'll likely find your money slowly depleting over time through dividend cuts and share price declines. It's an extremely tempting scenario that all dividend investors face. Not just when investors are first starting out with dividend stocks, but even experienced investors get tempted by risky above-average yields. For example, people will compare two business development companies side by side and they'll say to themselves, well, this one over here yields 6.8%, but this one over here yields 12.77%. I have $20,000 to invest, so if I do the math, I'll earn an extra $130.47 every single month if I go with the 12% yielding one. The more money you invest in a higher yielding stock, the closer you'll be to living off dividends since it pays more, or at least that's the illusion. What's almost always the case is the stock that's yielding the above average yield by far has a history of dividend cuts or coming very close to cutting their dividend. In our example, the higher yielding BDC, which is Prospect Capital, has gone through many dividend cuts over time. While that 12.77% yield is looking really enticing, think about its dividend history. Imagine you were relying on Prospect Capital's distributions to fund your livelihood for the next 20 or 30 years. In just the last 10 years, its dividend has dropped by 59.31%. In this example, if you're going to bet a lot of money on Prospect Capital and it continues to perform as it historically has, then you will eventually have to go back to work someday. You're just going to get too many dividend cuts and your income is going to drop significantly in the future. People who reach for the highest possible yields usually don't last long as dividend or income investors because they lack patience. It is true that some people have much longer time horizons than others. If you're 18, you obviously have a lot more time than someone who's 70. But if you want or need high income, then don't buy the investments that are offering a head-turning yield compared to what's typical for other companies in their sector. There's a good chance you'll go through a lot of dividend cuts and eventually you'll give up once enough of your money is depleted. The second common reason people won't retire off dividends is because they give up right before the dividend snowball takes effect. The worst year of dividend investing is the year that you start. You'll never earn so little in dividends in your entire investing journey than your first year. If you don't have a lot of money to invest, then the slow start is even harder to get through. Just like the first reason though, having patience is really crucial and it will pay off if you stick with it. You're likely familiar with what the dividend snowball is. It's the result of investing your money in dividend-paying stocks consistently over time, as well as allowing your dividends to reinvest. As time goes on, the compounding will speed up and you'll see your dividend grow significantly more the longer you remain a dividend investor. Much like a snowball, your income will grow bigger and bigger each month that you stay the course. Compound interest works magic the more time you give it. You can see in this example what investing $1,000 in a holding with 10% compound interest looks like. After 20 years, your investment would grow sevenfold thanks to compound interest. And you can see the vast majority of that growth came at the very end. Getting started is always the hardest, and most people don't have the willpower to stick with it. They'll often give up after a year or two where practically no results of compounding interest are evident. Aristotle said that patience is bitter, but its fruit is sweet. That sums up dividend investing for most people. It's really hard to wait for results for the majority of investors, but it's well worth it. Because like I said at the beginning, you're unlikely to ever come across a better form of passive income. And I mean truly passive, not something that requires an hour or two a month, but it's truly passive. Then third, and probably the biggest reason most people don't stick with dividend investing is because they're easily led astray by shinier investments in the market. At the very start, people like the idea of living off passive income through dividends. But after they start, it only takes one stock market rally to derail those plans. It's no secret that dividend investing is a slower long-term strategy. You never achieve a large amount of success overnight as a dividend investor. And yet, during market rallies, some companies can see explosive growth in their share prices. An excellent quarterly earnings report can send a stock soaring 10% or more in share price in a single trading day. Speculative stocks like pharmaceuticals can soar 20 or 30% in a day if their high-risk medicine receives FDA approval. That's a lot more exciting than a dividend-paying stock, which emphasizes dividends being paid into your brokerage account. Since we're only paid monthly or quarterly from our holdings, that's just too long for a lot of people. Entire sectors will see explosive growth at times, like tech for example, and all it takes is a company like Palantir or MicroStrategy to capture people's attention. You'll look at their share price and see how much they've soared in the past year. Surely if you get in on it now, it won't go through a correction or a downturn or anything like that. You start thinking about how much more you could make if you pick some good stocks based upon the hype surrounding them, not fundamentals or even dividends at this point. Maybe if you pick enough good investments, you can earn a lot more in the next year than in the next 5 or 10 years as a dividend investor. This kind of thinking typically appeals to younger investors. Instead of starting dividend investing very early and getting a head start on all of that compounding, immature investors would rather pursue quick riches. The nice car, the big house, these are all things that everyone wants right now, not in 10 or 20 years. Of course, hindsight is always 20/20. If you really believe that picking these kinds of investments is very easy, then why didn't you buy Bitcoin 10 years ago? Why didn't you buy Palantir 5 years ago? It's because you're not as smart or talented as you think you are when it comes to picking 10x stocks. Instead of trying to pick stocks that might explode in share price, wouldn't it be better to put your money into something that provides dependable cash flow? You don't have to check share prices every day and worry about the prices of your holdings. And when you reinvest the dividend payments, the next one is going to be bigger and then bigger and then bigger still. Studies consistently show that people who day trade or consistently make short-term moves in the market suck at it. You only hear about people's winners and they never talk about their losers. So those are the biggest reasons why people stop pursuing dividend investing. They all revolve around a very common theme, which is a lack of patience. Whether you're trying to invest in the highest yielding stocks for the most income now, not allowing the snowball to go into effect, or seeing other investments outperform dividend stocks, it's all about patience. If you want huge dividends now, then hold higher yielding dividend stocks. Just as long as you're not investing in insanely high yields like we looked at earlier. Like all good things in life, living off dividends takes time to achieve, so don't get discouraged if your progress is slow. But with that being said, that's going to wrap up today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.